Hey guys, today we're walking through an educational hypothetical case study on how to coordinate retirement withdrawals. We're going to be considering Roth conversions when appropriate, timing Social Security in a way that obviously might influence the way we model lifetime taxes. And while you're funding day-to-day retirement income, this is not advice. Keep that in mind. Results will vary and there are no guarantees. So let's jump into what we're looking at today. Imagine a couple retiring soon. We enter assumptions into planning software, balances in tax-deferred Roth taxable accounts, spending needs, inflation, estimated tax brackets, so on and so forth. In a default approach, they claim Social Security on a typical schedule and draw from accounts in the most common order. The software shows a modeled lifetime tax bill under those assumptions. Again, illustrative only. In the default path, bracket creep, required minimum distributions, and capital gains timing can compound tax drag over time. So the model helps us see when withdrawals may push income into higher brackets or increase taxation of Social Security benefits. Next, we model a coordinated sequence, being very deliberate about which accounts to tap and also when to tap them, considering cash needs, bracket thresholds, and potential Medicare IRMA effects. So it's not about any kind of tricks. It's just about thoughtful income ordering, or what we would call income planning, to manage taxable income while still funding your spending needs. We may also test Roth conversion windows if appropriate when current brackets, future RMD expectations, and time horizons suggest maybe there's some potential long-term benefit to you. So the model quantifies the trade-offs, taxes paid now versus modeled taxes later. Assumptions matter, and this is not necessarily a blanket recommendation. And the assumptions that are used, again, are very important. So if you're looking at this with an advisor or with a planner, you really need to talk about the assumptions that they're using and really the reality of what those look like. Social Security timing interacts with taxes and withdrawals. Timing of benefits is very dependent on your personal numbers and goals. The model compares various claiming ages to see how each path might affect taxable income over time. Being active and tactical in your investment risk management and aligning portfolio risk to your comfort and plan goals can help keep the plan durable during market ups and downs. Asset location, meaning what investments sit in which accounts from a tax perspective, can also influence obviously the tax characteristics of the withdrawal. So again, we're modeling, not promising, potential outcomes. Finally, we look at side-by-side modeled comparison. Default withdrawals versus coordinated sequencing with maybe possible Roth conversions and adjusted Social Security timing. Sometimes a coordinated path shows lower modeled lifetime taxes and different in portfolio values. Other times, assumptions shift the picture. And that's why your specific data and preferences matter. If you want to see your numbers modeled under multiple strategies, bring your tax professional and a qualified advisor into the conversation. The goal here is to give you clarity, understanding the trade-offs in your decision matrix so that you can make informed decisions. So thanks for spending a few minutes with me today. I hope you found this helpful. If you want clear direction for your retirement, let's have a conversation. Book your meeting online at retire-clear. That's retire-clear.com. And until then, this is Chris Wootton of Wootton Financial Group, helping you find clear direction for retirement.